Hi, everybody. This is Dr. Gregory, and we are going to start now looking at more details concerning substantive testing and what we're looking for in different types of account classifications. So we're going to start with Chapter 4, which is cash receipt and other asset misappropriations. In the occupational fraud report for 2022, asset misappropriation was pretty much 86% of the cases. And that includes everything from stealing cash to manipulating the AR accounts, looking at inventory, and other non-cash misappropriations. Now, the median loss was only $100,000, which may seem like a lot, but if we looked at financial statement fraud, even though it accounted for 9% of the percentage of cases that we found when we did the survey with other CFEs, it did represent the highest amount of loss. And that's because you are manipulating the results of financial statements, and that is actually easier to do at those higher levels of management. But we can find within a company many different positions that could be vulnerable to asset misappropriation. And so we're going to cover cash skimming and AR skimming, cash larceny, just outright stealing the cash, non-cash asset misappropriations, inventory, and fraudulent documents. So again, from the occupational report to the nations, occupational fraud report to the nations, we can see that areas such as cash larceny, cash on hand types, and skimming types of fraud takes between 12 and 16 months before these schemes usually fall apart. And they usually fall apart because they get caught. And they can get caught in a myriad of ways. Perhaps they're stealing cash from their petty cash fund, and then they go on vacation. And then someone else takes over the petty cash fund, and lo and behold, there are no cash shortages in the petty cash fund. Well, that could be a red flag warning that tells us that sometime during the year, maybe that cash had been stolen. One thing I recommend to all auditors, regardless of what you are auditing, is one of the first things you want to do is take a look at the vacation records and find out who's not taking vacation and what positions or duties do they hold. There may be a red flag there. There may not, but there may be. Now, the difference between skimming and just outright cash larceny is that skimming comes prior to the entry in the accounting system. It's also known as off-book frauds because the missing money is never recorded and it leaves no audit trail. Here's an example, and this example is something that I was involved in many years ago, a city park employee. Well, the city had a boat ramp, and people would come up and they'd get this little envelope out of a box and they'd put their $4 in it, seal it up, and put it in a lockbox. Really nice, a lockbox. And that was to pay for their boating fees. And it was pretty much an honesty position where, you know, if you didn't pay for it, well, you just cheated the city out of some money. But most people, it was on your honor and they always supplied it. So there was no receipt attached. It was just put the money in an envelope. The envelope said City of X, boat ramp fee. Put the money in, seal it up, put it in there. Now, that gave us some poor internal controls, right? There was no receipt that they could get so that there was a record of the payments. And what would happen is that the employee would come around every day and pick up the box of receipts. Well, some of those receipts would go into the employee's pocket, and part is recorded as boat ramp revenue in the city books. Now, because it was only $4, people are not going to write a check. It was just cash. So what would be recorded in the revenues was whatever the city employee wanted it to be. Some days were good, some days not so good. And no one knew until the employee took vacation, was on leave, and another employee picked up the receipts. And all of a sudden, over that week or those 10 days that that employee was on vacation, the receipts were higher. So there was a lack of understanding sales. So there was no one out there to maybe spend a day and monitor the boat ramp, count the number of boats going in, and then making sure the number of envelopes equaled the number of boats that we were clocking going in the lake. And so there was no one that really understood the sales. So they didn't understand how many boats were going in, how many sales they should have anticipated, until all of a sudden, for those 10 days, miraculously, the cash counts were much higher. The employee was fired, prosecuted for theft of over $20,000 a year. And the reason why, when they arrested the person, they felt that they weren't appreciated enough, because they had to go out there sometimes in bad weather, and no one was concerned that they were in the bad weather, so they just felt that they were being underappreciated. Now, an AR skimming example, again, it's before it gets on the books. The AR is on the books. So we have a payment that comes in, and when they come in and they make the payment, instead of booking the payment against customer A who paid their bill, we issue a credit memo. Now, normally a credit memo would go back out to those customers, which would alert the customer, well, why would I get a credit memo? Because I made the payment. Well, in this case, the employee printed the credit memo out because there's a report, and their supervisor saw the report and saw the list of credit memos. So they would sign off on all of them. But instead of sending it out, they would just throw it away. They would just shred that document. So the customer was never the wiser. Now, cash larceny is just when we steal the cash from people. We get the cash, and here's a really, really good example. This gets a lot of attorneys in trouble, especially those who hold trustee positions as trustees of estates or trustees of clients. The attorney is the trustee for several clients. All of the funds of these clients go into one account. Now, by law, the attorney needs to set up a separate bank account for each one of their clients so they can track the money coming in and the disbursements going out. But in this example, the attorney then spends the money without documenting the money, where it came from, or what it is used for. So it's just cash larceny. The problem is we have very little trail. So then you have to go back to the clients and figure out, well, how much did the clients bring in, so we could figure out how much should have been in each account, and then look to see what the disbursements should have been on behalf of those clients. Now, in example number 2, this is a simple cash larceny. We've seen this many times in doing retail audits. An employee is standing at the cash register, rings up a sale, takes the cash, and then after the person leaves, and before the next person comes, they void the sale. Now, a good internal control that you could use for that is you have to have somebody else that approves the void of the sale, and you hope that there's no collusion between the voider and the cashier. In non-cash misappropriation schemes, this is where we have misuse or abuse of an asset, using the company vehicle during non-working hours. Usually, if you use the company vehicle, it's to perform certain company duties. You might be able to take it home, but you have to take it straight home and park it and leave it there the night. You don't use it then to go out with your friends or take people out to a party with that company vehicle. Another one is using a company computer to do personal work on company time. The company is paying you to perform your job. And if you're using the company computer to do personal work, then that's a violation and a misuse of an asset. Another one that comes around during election season is employees using company computers to do campaigns, especially if they are public servants. You cannot use the company computer to print off election material or to use it to access customer records. Those are all misuse of an asset. Some people ask me, well, how would you know if someone took a company vehicle during non-work hours? Well, one, you should be logging in, or you have a motor pool that logs in and out of your company. Everybody who's got a car, and then you are routinely taking the mileage records and then making sure that the mileage records are appropriate for what that person is performing. We had a case down in Texas where a nonprofit had a company car for a CEO, and it was only to be used back and forth to work. Well, we found out that there was a misuse of the asset when the CEO's daughter had a car wreck and was driving that car. So sometimes that's how you find out if they are doing the vehicle during non-work hours, or they park it and somebody vandalizes the car or, breaks into the car. Now, non-cash larceny, again, larceny is we just take the cash, right? We just take the cash and walk out with it. Non-cash larceny involves the taking of inventory, taking inventory out of the back of the business, taking clothes. Sometimes employees are asked to wear clothes of that retail company as part of marketing. If you're wearing one of the dresses that you're selling and it looks really good on you, then other people will say, oh, that's a really pretty dress. I want that because I can see how it fits. Well, they're supposed to change their clothes before going home. Some don't. They just walk out, or clothing just walks out of the back of the inventory. So you need strong inventory control measures to reduce the risk that that's going on. I've seen food going out of the back of restaurants, alcohol going out of restaurants. Another non-cash larceny is fake sales. It looks like a sale, but there are no sales records. So someone comes up and they are colluding with the cashier. The cashier rings up the sale, so it looks like a sale, but there is no sale record. So again, they void it or they give it a credit back. What we find is, while that is coming out in the sales records, we aren't tying that to the inventory. So the inventory should match the sales records. If something was sold and then we voided the sale, that inventory item should be on the racks. That's sometimes where barcodes can come in handy, is you barcode all of your inventory, especially if it's high-end inventory, so that you can keep track of the records of those sales. Now, we've talked about inventory walking out of the back. Now, sometimes there's inventory shrinkage, and that is a part of doing business. but there needs to be acceptable levels of what shrinkage is. Shrinkage could be due to the fact that we bought and paid for the inventory items, and then we found out that maybe they spoiled. That happens. It happens a lot with perishable goods. Sometimes with retail inventory, such as clothing, it could be that there was a smudge on the blouse that can't be cleaned. That's inventory shrinkage. It's part of the normal process. Now, it becomes an issue if that acceptable level starts to increase or it's continuing. Maybe we notice that milk, 3 days past pull date, we have an acceptable level of inventory shrinkage or spoilage. But all of a sudden we start seeing that continue on past the 3 or 4 days. That might be a red flag that good inventory is being mislabeled as spoilage and is, again, going out the door. So there's 2 basic ways of tracking this: manual and automatic. A perpetual and a periodic system. Perpetual systems are always the best, but when you have large volumes of homogeneous inventory, that can be pretty hard to do. So you need to do regular manual physical counts, which can reduce the risk, especially doing some of those counts around that time where you think that the acceptance levels are solid for that inventory item. So if we know that after 3 days, the spoilage of milk inventory should be off the shelves, on the 4th day, do a count. Make sure it's off the shelves. Then you know it should not be continuing on the 5th or the 6th day, right? Here's an inventory shrinkage example, an acceptable one that I worked on. I used to audit a seed company up in northern Washington called Christensen Seed Company. Now, aged seeds become shrinkage. If you've ever bought a package of seeds from anybody, you'll find out that it's like best by a date, and it's good for usually 1 or maybe 2 planting seasons. There's a reason for that. The seeds will start to dry out. They may not mature. You would get poor crops. So they do have an expiration date. So we would normally see seeds going through a spoilage or shrinkage, and they would estimate, and again, look at the rationale of estimation as to why that expiration was. Every container of seeds that they use, these large containers of seeds, would have a date that it was packaged and then a date when it expired. Well, after that date the expired, those seeds should be pulled. Now, not so acceptable inventory shrinkage is stealing inventory and then writing it off as obsolete, or donating it and then getting a fake receipt of donation. So you have to look at what type of inventory you're working with. Stealing inventory and writing it off as obsolete could be seasonal clothes, but some clothes carry on season after season. Or inventory that really hasn't spoiled and calling it spoiled. Another not so acceptable inventory shrinkage is padding the inventory using fake empty containers. If you ever go out and do a physical inventory count, open those, not only that you can see, but you might not have easy access to. For example, when I was with the seed company, working with them, there were seeds in warehouses, and I would pick a box way up in a corner somewhere, and I'd say, pull me that box. I want to see what it is. And then observe, and then, physically look at the box of seeds. Sometimes you have to do that because they call them fake castles. And you know, a castle has the big walls around it, and then the castle sits in the middle. Well, the fake walls are all of the real inventory, and then on the inside are empty boxes. But if you don't look at that, you don't know. So when you are looking at your inventory, pick inside and outside. Pick far away and close to you to make sure that you don't have these fake castles of inventory boxes. Now, some of the things we could do to prevent and detect these types of losses is matching documents, making sure we have packing slips with purchase orders and invoices, and comparing. Did we get 5 items? Did we ask for 5 items? And did we pay for 5 items? And then we want to do some unannounced inventory counts. So how much have we sold so far? Well, we've sold 2 of these. There should be 3 in inventory. Go find the 3. You could perform trend analysis, looking for anomalies such as, large donations. Well, why would there be large donations from a company that may not be doing a lot of donations? You might want to look at that. Maybe large charges to voids, returns, lots of sales to scrap, credit memos. Looking at those accounts, not just the revenue accounts, but look at the credit accounts. Look at every time there's a negative revenue, a debit to the revenue account, and find out where that's going, where that is. Looking for clear and multiple levels of authorization. Like I said, if you have a void, if your company does voids of sales, make sure that the salesperson cannot void the sale. They have to call a manager over with a special key or barcode that allows them to do that. That's the end of this chapter. I hope you found it pretty interesting. And if you have any questions, please post to class questions for the good of the class. You can leave me a message on Halo, or you can make an appointment with me in Calendly. Have a great week, and I'll see you in the classroom.